Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from CVW CleanTech Inc. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Akshay Dubey, CEO and Director, and Joshua Grant, CFO of CVW CleanTech Inc., which trades on the OTCQX Best Market under the symbol CVWFF and on the TSXV under the symbol CVW. Welcome, Akshay and Joshua.
Perfect. Thank you, Matt. Firstly, I'd like to thank the OTC for organizing this great event and appreciate all of you taking the time to join us. Also, before we get started, there is certain forward-looking information in this presentation, and the nature of how the economics of our technology will flow to CVW CleanTech is still very much a discussion taking place with our potential partners. In regards to the CVW CleanTech story, we have a game-changing technology that could reduce Canada's emissions by 0.5% while recovering over 12 million barrels of oil per year and becoming one of the largest and greenest producers of critical minerals in the world, completely from reprocessing waste from the mining oil sands space. We believe this technology will lead to a financial structure that will look very much like a royalty on a commercial facility, given the nature of our potential oil sands partners and the sites our technologies will be deployed on. In this vein, we're also actively reviewing potential opportunities to diversify the CVW CleanTech platform through potential royalty structures on third-party technologies to create a diversified platform across the board. As mentioned, there's some forward-looking information here, and here you'll see the disclaimer slide in regards to this information. So the CVW CleanTech story. Importantly, we're focused on the oil sands mining space. This is an important industry that is required as part of the general industrial complex and energy complex going forward. The oil sands space have targets to be net zero by 2050, and we very much help with those targets. Our technology has a very attractive financial return that we will walk through as we go through this presentation. And importantly, we help with the overall ESG story of the oil and gas space, specifically the oil sands mining space, in regards to two of their key areas of concern, which are emissions as well as their tailings ponds. In regards to the company itself, we're in a strong position today with over $6 million in cash on hand. This will allow us to complete any work required before getting to a final investment decision. People often ask if there's an equity raise coming in terms of shoring up the balance sheet in the near term, which is very much not the case in our situation. We have a very solid balance sheet, and we expect that from a burn rate perspective, this will take us out for the next 4 to 5 years with some option and warrant exercises expected as well. The other key thing I'd like to point out is the fact that management and board here are very much incentivized alongside shareholders. Our focus is very much on creating value per share. We all have equity in the business, and so we would very much want to grow this business in a way that benefits all of our shareholders. On our board of directors, you'll see some very high profile and well-respected entrepreneurs and individuals in the business community. This includes Darren Morcombe, who's our chairman and our second largest shareholder. Darren has had a very successful career building a variety of businesses, including the world's largest gold refining business. He's also a major shareholder in 4i Mining, which has been one of the most successful copper stories over the last few years. So Darren's very experienced in building companies like ours and has a very active role in our ongoing strategy and management. We also have John Bruce on the board, very well respected in the Calgary space, has a variety of relationships across the energy sector. And so to have his sponsorship and his ability to help us open doors in the oil and gas industry is incredibly helpful. And then, of course, we have Pierre Lassonde on board as well. While Pierre is not a board member, he is a special advisor to myself and the board. He is also one of our largest shareholders and has bought 10 million shares on market. So we appreciate his support and his ongoing guidance in terms of how we can think about building the business. From a management team perspective, I joined as CEO and director in September of 2022. So I've been in the seat a little over a year and a half. My background is very much from a capital markets perspective. I've worked in the natural resource industry my entire career, starting off in investment banking, but then spending a bulk of my career at the Ontario Teachers Pension Plan, where I was focused on energy investing for a few years, led the mining strategy for the team, and then led a portfolio company that was a joint venture between Teachers and Glencore. From that perspective, understand the commodity space well, both energy as well as minerals, which is why CVW was interesting. But more importantly, from a personal perspective, at this next stage of my career, I wanted to focus on something that had the ability to create a lot of value, both for the shareholders as well as society, but also had a more of a sustainability angle to it that could really help from an environmental perspective. And that's where I thought CVW CleanTech was very unique and really brought me on board in terms of looking to turn this from a technology into a business. We also have Josh on board here as our CFO, who joined mid last year. Josh's background is again from the resource space and manufacturing space from a finance perspective. He's been a great addition to the team. And then rounding out the senior team is Kevin Moran, who's our EVP and Chief Technology Officer. Kevin's background is from the oil sands space. He worked at Syncrude for a long period of time following his PhD in chemical engineering. And so Kevin knows the industry, he understands the challenges that they face, and he realized that there was a better way of doing things. And this is why Kevin joined CVW back in 2008 to really pioneer our technology and bring us to where we are today. So from a macro perspective, the one thing I'd like to point out is the world continues to need hydrocarbons. We hear a lot in the media about the push to net zero, renewables, etc. But in very few projections, if any, do we see oil production or oil consumption falling in the next 20 to 30 years. The reason for this is a large portion of the world still doesn't have reliable access to power. And within that context, we need to utilize all the resources we have to be able to provide people what they require. What this means is oil is going to continue to be needed. It might be a smaller part of the energy mix going forward, but it's very much going to be needed at or slightly above current production levels, whether you look at the IEA's flagship report or more recent reports that have come out in the last few months. Within the energy context, the oil sands remain a critical asset. They're located in Canada, which make them part of a very secure jurisdiction. They're also part of the North American energy complex, which is required by refiners down south in the U.S. So from that perspective, they have a long life in terms of being able to produce going into the future. You couple the fact of energy security with the fact that they're the world's fourth largest reserves, and we view the oil sands to be a critical part of the energy space moving forward. So in the context of a world that's moving to net zero, how do we reconcile the use of oil and the use of oil sands in terms of being able to produce that oil, but doing it in an environmentally sustainable manner? Well, really it comes down to two things. It comes down to innovation, and it comes down to the industry having the appetite for putting this innovation into play. There are two areas where the oil sands specifically need to improve their environmental performance. One, emissions. The Canadian oil sands make up about 11% of Canada's total emissions. And the second part of it is the tailings ponds. And so tailings ponds are where they produce and collect their waste, which are turning into some of the largest environmental liabilities in the country. Luckily, the CVW technology can help with both of these aspects. We can help decarbonize the oil sands, but we can also help them move away from the use of tailings ponds completely. In terms of the oil sands space, it's important to note that there are two types of oil sands assets. There are mining assets as well as SAGD or in situ assets. Mining assets use traditional truck and shovels to dig up the sand and put it through a series of processes to produce bitumen, whereas SAGD or in situ pumps steam deep into the ground to liberate the oil that flows to surface. Our technology is only focused on the mining oil sands piece because they produce tailings, whereas SAGD or in situ operations do not. So that would be about half of Canadian oil sands production, which would be about a third of total Canadian oil production, right around 1.5 million barrels per day. Here on one satellite image, you can see the entire oil sands mining sector. There are 6 operations operated by 3 large companies. There's Canadian Natural that has the Horizon and Albion oil sands complex. Suncor operates their base plant, as well as the Syncrude JV and Fort Hills. And then Imperial Oil, which is ExxonMobil's Canadian subsidiary, operates the Kearl oil sands site. Collectively, these are the 6 assets that make up about 1.5 million barrels a day. A couple things to point out on this slide. The distance between these assets is fairly short. So if you can see Horizon in the northwest and Syncrude there in the southwest, that's about a 40 to 50 kilometer drive. So very much one localized region. The thing that splits these assets that kind of on the left, like Horizon and Syncrude, versus the right, like Albion and Suncor, is the Athabasca River. So this is the major water source for the communities in the region, but also for these oil sands operations. Conversely, it also creates a large risk because any tailings ponds, leaks, etc., that flow into the Athabasca River can have a huge impact to the entire region. The other thing I'll point out is tailings ponds. So for every barrel of bitumen they produce about 1.5 to 2 barrels of waste. In the southwest corner of the Syncrude asset there, in the bottom left of the image, you can see what looks like a lake. That lake is in fact a tailings pond. That specific tailings pond is 4 kilometers wide by 8 kilometers long, full of tailings waste. This is only one of 4 tailings ponds on the Syncrude site alone. I've come from the mining industry. I've been to 2 of the world's 5 largest copper mines. I've stood on their tailings ponds. They are dwarfed by what you see in the oil sands space. So how does an oil sands mine work, and how does the CVW technology fit in, and what do we deliver? So really, from an oil sands mining perspective, they dig up the sand, which has about a 10% bitumen content. They put it through hydrotransport by adding water, so it flows through a pipeline. It ends up in an extraction plant where through flotation, they're able to produce what's called bitumen froth. At this stage, this froth is about 60% bitumen. That ends up in a froth treatment plant where they add a solvent, either naphtha or paraffin. That solvent allows them to extract the bitumen from the solids and other material, and they're able to recover 97 or 98% of the bitumen, which then flows into an on-site or off-site upgrader to produce a high-value product like synthetic crude oil. The waste of this entire process is called tailings. That tailings comes out of number 3, the extraction plant, as well as number 4, the froth treatment plant. Froth treatment tailings are only about 5% to 10% of total tailings volume. The challenge, though, is froth treatment tailings are much harder to deal with than extraction tailings. The reason for that is extraction tailings are generally have very low levels of hydrocarbon concentration. They're mostly sand and water. Froth treatment tailings, however, have high degrees of hydrocarbons in them, about 3 to 5%. But they also have solvent in them, about 0.2 to 0.3%, which doesn't exist or naturally and doesn't get introduced to the process until froth treatment. This solvent has a variety of challenges associated with it. One, it can flash off into the atmosphere as VOCs, or volatile organic compounds, which poses a major health and safety risk in the region. In fact, you can smell the oil sands from 5 to 10 kilometers away. That's because of the VOCs that are being emitted into the air, the majority of which come from the solvents that end up in the tailings pond. The solvent also turns into fugitive methane emissions. So on an annual basis, these tailings ponds release somewhere between 300,000 to 500,000 tons a year of CO2 equivalent methane emissions. There have been years in the past where, for example, Syncrude has reported to the Alberta Environment and Parks 1 million tons of CO2 equivalent methane emissions. Our understanding is this is the single largest source of fugitive methane emissions in the country. So given the focus on the reduction to carbon emissions and fugitive methane emissions as part of Canada's commitment, global commitments, it's important that we can address area sources like these tailings ponds. This is where the CVW CleanTech technology fits in. We would be able to take in 100% of their froth treatment tailings and put it through our patented concentrator plant. Through fairly well-known processes that have been modified by our team and patented, we are then able to recover about 90% of the solvent that exists in that waste stream and over 85% of the bitumen. What that means is we would produce about 2 million barrels of oil and 300,000 barrels of solvent per site completely from waste with a negative carbon footprint. How would we have a negative carbon footprint? By avoiding the solvent ending up in a tailings pond, we would help the operators abate over 90% of those fugitive methane emissions. Our concentrator plant would then also be able to produce a mineral concentrate, which would then go into a mineral separation plant that you can see in number 7, where we can recover titanium and zircon. Titanium is a critical mineral in Canada, the US, Europe, and a lot of other Western countries. And zircon as well is a critical mineral in the US, Australia, Japan, and we're currently in conversations with Natural Resources Canada for the reasons it should be added on the critical minerals list for Canada as well. So we're able to produce through our process 250,000 tons of critical minerals per site. We could be 8% of the world's titanium production and 15% of the world's zircon production when deployed across the industry with a negative carbon footprint, recovering these minerals completely from waste. Finally, the tailings or waste of our process comes out of our concentrator plant and our mineral separation plant. That could go through a thickener where we recover water for the operators to reuse, and then we produce ready to reclaim tailings. These tailings are Alberta Energy Regulator certified, so they do not need to go to a tailings pond. They can go back into their old mine sites so that they can go through progressive remediation, something that they're simply not able to do today. So the CVW value proposition is really that we can recover valuable commodities, both critical minerals and hydrocarbons, completely from waste. By doing this, we can help decarbonize the oil sands by reducing their site-wide emissions by 5 to 10%, reducing their overall methane emissions by 90%, and helping reduce Canada's total emissions by 0.5%. By doing this, we reduce their operating costs on site. There's carbon tax savings, but also savings associated with less tailings to handle. And finally, we provide them that step change in tailings management so they can move away from the use of tailings ponds. All of these GHG benefits that we've mentioned have been quantified and reviewed by third parties. So we've been sponsored or provided funding in the past by Emissions Reduction Alberta and SDTC, which is a federal organization. They both went out and hired independent firms to review our numbers when it comes to GHG emissions reductions, and their numbers are actually closer to 600 to 650,000 tons per site. We use a number of 380,000 tons per site because we use the numbers industry is reporting to the government and build on that in terms of our total emission savings. Here you can see our value proposition again. Mentioned some of the commodities we produce, the 1.9 million barrels of bitumen, 300,000 barrels of solvent, but importantly, there are other things that we provide as well. We provide water use reduction of 2.8 million meters cubed per year. That's through the water that we recover from the thickener that we provide back to the operators. There's heat integration benefits because we provide heat back to the operators. They need to burn less natural gas. That's about 1.9 million gigajoules a year of natural gas that doesn't need to be burned. And then also we help them with other things on site like pyrite mitigation and norms removal, both of which are important from an environmental perspective. What does this all mean from a financial perspective? Well, here you see 3 different approaches to development that we've provided the market in the last year. There's the eco-base model, which is focused on hydrocarbon recoveries. It costs $390 million in capital. There is the eco-max model, which is both the mineral separation plant as well as the hydrocarbon recoveries. That's $1.1 billion. And then the eco-flex is really a phased approach where you build a hydrocarbon concentrator in phase 1 and you build a mineral separation plant in phase 2. Our focus today is very much on the eco-base model for a couple of reasons. One, it has a much lower upfront capital cost at $390 million, and it has attractive returns. Based on the financial numbers you see here, we expect those numbers will be in the high 20 to 30% IRR range at the project level. The components of revenue for that eco-base would really be hydrocarbons, so about $135 million a year in hydrocarbon revenue at $60 WTI. GHG abatement benefits, so the carbon taxes operators would save by putting in our technology, using $170 a ton, which is the federal carbon tax schedule in 2030. That would be about $70 million a year in carbon tax savings. And then there's about $40 million a year in additional cost savings for the operators from the less tailings to manage, as well as the heat and water integration benefits. So on this basis, we produce something around $250 million a year in revenue, about $25 million a year in operating costs and sustaining capital, And if you take out things like bitumen royalties, et cetera, we expect this eco-based model should be able to produce somewhere between $120 and $130 million a year in after-tax free cash flow, which makes it a very competitive and very interesting project. In terms of how we would look to finance this project, from the $390 million, we've come up with a financing structure that would have about 40% in equity and about 60% from debt and the government. So we've received 5 comfort letters from large institutions in regards to the credit, which we press released in December of last year. This shows that we can comfortably raise the 30% required from a debt perspective. We're also in advanced discussions with the government around the applicability of things like ITCs to our project, whether that's the carbon capture and storage ITC, which provides 50% of your capital, or the CleanTech manufacturing ITC, which provides 30% of your capital. We expect we should be fitting within some of those programs. But alternatively, there are also programs that provide direct financing, like Emissions Reduction Alberta, the Canada Growth Fund, the Strategic Innovation Fund, and we are in discussions with them about providing support to our project. We have a track record of raising significant amount of government capital to help support our technology, and we expect that we will be able to raise 30% of our total capital from government sources. This leaves about 40%, where CVW CleanTech is proposing that we would split the capital with our oil sands partners, which would be about $80 million for CVW and $80 million for our oil sands partner. We're also currently working on a potential partnership with Indigenous groups in the region. The goal is to have them join as partners at the project level so that they can fund alongside us, ourselves, and the operators and get a financial interest in the project. We expect that these negotiations will continue, and we should be able to show the market something around Indigenous partnership and participation in the next couple of months. What this does is it takes a project that had about a 30% base case return and increases the project returns in that 40 to 50% range for the equity holders, which we believe is extremely competitive relative to any other projects that the oil sands operators may be looking at today. Our project has gone through a significant development timeline of over 15 years, and $100 million has been spent on our project and technology. You can see some images of our pilots here on the right side. This pilot was done over a 4-year period at industry scale with full participation from industry. Once the pilot was completed in 2014, we entered a period of front-end engineering where we worked with Canadian Natural to do a series of exercises, including a pre-feed study, a feed study with an independent engineer, and then a feed and optimization study, which was completed in 2021. This took our technology to a TRL level 8, which means we are a shovel-ready technology and ready to go. So really, our technology lines up with a lot of stakeholder priorities, whether it's the communities in the region or the federal and provincial government, but also with industry's priorities when it comes to moving away from tailings ponds and moving to net zero. So we expect our technology is one that should be extremely competitive and extremely attractive for the operators. And our focus this year is really moving this technology ahead into commercialization. Again, this just displays our track record of government support. We've received over $80 million in grants to date. This has helped get our technology to where we are today, and we expect significant additional support in terms of commercialization. That's the end of the presentation. Appreciate you joining. Maybe we'll move over to questions now.
Thanks, Akshay. So we've received a number of questions, and I'm going to go through them in order here. What is the total addressable market for our services?
Great question. So our total addressable market is small in that there are only 6 operations and 3 operators that can use our technology. At the same time, as mentioned, these are some of the largest oil assets in the world. They all produce about 250,000 barrels a day, collectively 1.5 million barrels. So from our perspective, if we were to roll out this technology across the space, we expect that we can create somewhere around $3 to $5 billion in total value for our shareholders. Again, looking back at the eco-based model, that's about $120 million in after-tax free cash flow for a single asset. If you multiply that times 6, it gives you a sense of how large that could be just on the hydrocarbon recovery side.
Okay, thank you. And that kind of dovetails into one of the subsequent questions. So we'll go out of order here, but is our solution specific to oil sands projects? Can it be utilized for other methods of oil extraction?
Our technology is very much focused on oil sands. The secret sauce or the patents really lie on our ability to recover hydrocarbons from a froth treatment tailing stream, which is again very specific to the oil sands. That being said, what we are looking to do is think about our company more holistically as a clean tech royalty platform, with the ability to look at other technologies through a royalty financing structure, and turning ourselves into that diversified platform.
An additional question came along the similar train of thought in terms of can our technology be used to remediate existing tailings ponds?
So from an existing tailings pond perspective, that's really where our technology was initially piloted. So if we go back to one of our slides, you can see images there that basically show that our technology was being piloted right on site at Syncrude, and that was really to go back to the tailings ponds themselves. Apologies, I'm just going to move back to that slide here. So right there on the top, you can see that first pilot that was done at Syncrude. That was really to be able to go and get the minerals from the tailings ponds. The feedback we received from operators was, we don't want you touching the current tailings ponds because they're extremely sensitive from an environmental perspective. If you can do something about fresh froth treatment tailings, that's much more interesting for us. So our technology was then adapted to be able to take in fresh froth treatment tailings. That being said, if there was an interest from the operators to be able to go into the current tailings ponds to extract minerals, that's certainly something that we would be able to do as well.
Okay, thank you for that. And a question came in, what are our key milestones for 2024?
So our key milestones are really around the variety of de-risking opportunities that we've been looking at. So we announced two of those. One was in regards to our financing package and getting the debt comfort letters in December, which was a great accomplishment for the team. We also announced technology deployment insurance, which further de-risks the implementation of our technology. The next thing we're looking to release into the market is a roadmap or EPC plan that provides folks comfort around the cost to get to an FID, what the timing around that looks like, but importantly, what will execution of our project look like? What we would ideally like to get to for our first project is an EPC plan that looks like a fixed price turnkey contract. So what is the work required to get there, and what is the timing to get there? So that's something that we're looking to release to the market, which again will give both the market as well as our oil sands operating partners comfort around an execution plan. Separately, the next key catalyst we feel from a corporate perspective will be announcing Indigenous partnership for our technology. There are 7 Indigenous groups that are common to the 3 operators and live in the region of the oil sands. So ideally, we would like to have them come on board as partners so they can participate in the development of our technology and benefit not only from a social and environmental perspective, but from a financial perspective as well. The next piece that we're really hoping to also nail down this year is government financing support, whether that's inclusion in the ITCs or support letters from their funding groups. We're looking to provide our operating partners in the market comfort that we are able to deliver that 30% in total financing that we've set out from a government perspective. Then really the focus is going to be on the oil sands operators and looking to get a deal done with them to move our technology into a commercial state. In another vein, though, we are actively looking at potential diversification opportunities, and we expect that we may have one that we can announce this year, alongside a strategy as well as a pipeline to show the market how we're going to transform CVW CleanTech from a single technology company into a clean tech royalty platform.
Thank you. Additional question came in. Why would an oil sands operator not engage with CVW?
I'd say the biggest challenge is, and people often ask, are there competing technologies? I'd say overall, there aren't any competing technologies. You can see that through the patents that are filed. The challenge is more so alongside the status quo. Oil sands operators are generally focused on business as usual and returning as much cash to shareholders. So for example, in the last 24 months, these 3 companies collectively have returned $40 billion in cash through dividends and buybacks to the shareholders. So within that focus, really part of what we've done in terms of our technology is come up with a compelling economic solution. I think being an environmental solution is important, but that alone is not going to carry the day. It has to make money for these operators because that's how they're incentivized and that's what they're focused on. So we've really spent our time over the last 6 months to a year de-risking our project, increasing their confidence around our execution, but also showing them a pathway to returns that are competitive against any of their other capital opportunities.
Okay, so that I believe that's the end of the questions we've received. On behalf of actually myself and everybody at CVW CleanTech, thank you for attending our presentation today, and would encourage you to either book a one-on-one meeting through the platform or follow us on LinkedIn or through signing up for our newsletter.